Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
I want to start the presentation by asking everybody here a simple question. This is a very powerful question, though, and it's what in life should you control? Now, I want you to think about that because in life, there's lots of things we can control, right? You know, health and all these kind of things, but there's three main things that a lot of people have to understand that you're going to want to control if you want to do certain things. And so think about this. What are main three things in life that you want to be in control of that maybe you're not? Maybe you're giving control away to somebody else without even knowing it. So what are those three things? So the first one here is money. We're taught to trade time for money, give control to somebody else, by the way, and we also give our money away to other people without even really thinking about it. So in reality, if you're not controlling money, it's very hard to control that second thing. That second thing that we all want to control in life is our time. Because that's the one thing that once it's gone, it is not coming back. We all have limited time here. And so we should want to control that as much as possible. And by the way, for me, time is the one thing that I want to control above all else, above money, above everything. I love to control my time because, and now you'll see kind of my history. I did not do that for a long time. But in order to control time, what do you got to control? Well, you got to control the money first, right? So money typically comes first so that you can control time. But before these two things, there's one very important thing that you've got to control before these two things, and that is your mindset. It's what you have up here. It's what you know. It's what you understand. It's that mindset, or as I call it, your programming, your subconscious programming. And so if you don't control your mindset, I guarantee you somebody else is going to control it for you. Think of our education system. Think of the influences around us. Social media, all those kind of things are trying to control, by the way, your mindset, which means they can eventually control your money and even your time too. So there you go. So in this presentation, this concept we're going to be talking about is how to control these things in our lives, right? But I'm going to be challenging your mindset. So I want you to keep an open mind as we go through this. Now, I want to share a quick quote for you that we all hear at the BYOB team really like. And that quote is this by Will Rogers. And it says, "The problem in America isn't so much what people don't know, it's what people think they know that just ain't so." So once again, as we go through this, I'm going to be challenging the way you think about money, especially because we're all taught a certain way around money, to give it away, to have somebody else control it. So we're going to be challenging that. So once again, keep that open mind. All right, now I want you to envision this scenario. This is pretty powerful. So I want you to think about 18-year-old kids. So put 100 of these kids, 100 18-year-old kids in a room like today, and ask every single one of them, where will they be at the age of retirement? Say 65 years old. Where will they be? Well, what are they going to say? I'm going to be broke and poor? No, of course not. They're going to say, I'm going to be successful. I'm going to be wealthy, a billionaire, a millionaire, whatever. But they're all going to be pretty jazzed. I'm going to be very successful in life. But here is the reality of the situation. When you fast forward to age 65, only 5% out of those 100 kids will be financially secure at the age of retirement. Not 10%, not 50%, only 5% will be financially secure. And that's crazy to me, by the way. When we live here in the United States or Canada, I mean, there are so many opportunities here, but yet only 5 people will be financially secure. Not free, by the way, just secure. And by the way, that stat comes from the Social Security Administration. They literally say that 5 out of 100 people will be financially secure at the age of retirement. So a question for everybody here. I know a lot of you have seen this presentation many times, but who wants to be one of those 5%? or do you want to be one of the 95% that is struggling, that is challenged financially throughout their entire life? No, we don't want to be that. We want to be that 5%, right? That's what we want to be. And that's what this concept we're going to be talking about here today can help you do. It truly can. Because and I've studied successful people, I've been around a lot of very wealthy people, and they do things a bit differently. And that's what this concept is about. It's about doing things a bit differently than everybody else. Before we get rolling, who am I? So my name is Brian Fouts. Some of you don't even know who I am. That's my degree in construction management and business. I went to Washington State University, go Cougs. I have not seen that degree in probably 12 years. I have not used it in a long time, but that's what I did. I went the traditional path through life, and I call that the hard way, right? I was raised lower income, great family, parents all still together, all that kind of stuff. But money was never in abundance when I was young, and I never really thought about it because I was never taught about money when I was at a young age. But I did that traditional path: go to school, get a good job, go work in corporate America. I did that, and I had a 401k. I had that house with a white picket fence and the mortgage, the growing family, and all the other things that came along with it, debts, etc. And I was told that was the American dream. And yet, I remember back then, I did not think that it was the American dream. It felt like kind of the American nightmare because I was always felt like I was struggling financially. I was like, man, this is kind of sucks. And I was always like in debt. And what happened is I was at a doctor's office and I picked up this magazine about finances. Never studied that before, never taught that in college, by the way. And there was this article talking about net worth, and it said millionaires know their net worth. Everybody else doesn't in most cases. And I was thinking to myself, uh-oh, I'm one of those other people. And I did the math when I got home, and that's the actual piece of paper right there that I did it on. I don't have it anymore, but I took a picture one time. I was worth a negative amount of money after 10 years in corporate America. That made no sense to me. I was like, and I did the math, and I would be further and further into debt every single year. I'm like, this is insane. But I'm doing what everybody else around me is doing. And so I realized that, this is like the WTF moment, right? And so I had to do something different. And my grandfather, he worked very hard into his 60s to retire, wanted to go do all these fun things at retirement. He was a pillar of the community kind of guy. He retired. And for about a year or two, he did the fun things, but then he got very sick. He got leukemia, he got Parkinson's. And I remember right before he passed away, he pulled me aside one time. He could barely talk because of Parkinson's. And he said, "Hey, live your life now, don't wait." That was one of his big key pieces of advice. And I was like, okay. So I kind of took that to heart. And I eventually left corporate America because he passed away without living that kind of life he dreamed of. Had a huge impact on me, huge impact. So, anyways, I started some businesses, bought some businesses. Anybody can say anything, but here's one of my businesses back in 2021 during COVID was doing over 2 million. It was an Inc. 5000 business, by the way. And the concept we're going to be talking about here today, this concept helped me with this business to create this kind of a life and to really do a lot of fun things. So I love to control time, as I said. This concept has allowed me to do that. And I have had a lot of fun experiences. I travel a lot, and I do a lot of fun things with my family. I love classic cars. You guys can't tell, but we've had a lot of fun things, and it's because I control my time, control my money, that kind of stuff. So it's also allowed me to do some really fun things, like I'm here right now. I love talking about this strategy. I love sharing it with it. I love helping other people. This is actually a high-level mastermind where I used to go and teach this concept to other people on stage and in front of people. So I've been doing this for quite some time, and I love it. So let's kind of go ahead and get into it. All right. So one thing I want you to understand that this concept, it's not new. It's been around for a long time. Oh, I mean, we're talking hundreds of years. And in fact, there's a lot of people that teach about this. Okay. So Robert Kiyosaki, by the way, great book, Second Chance. He talks about this concept in his book. And by the way, one of his advisors, his name's Patrick, was actually my mentor with this concept. So I've been around a lot of these people that do this. Tony Robbins, I've been to a lot of his events. I've walked on fire, all that kind of stuff. But he talks about it in his book, Money Master the Game. And then, of course, there's the kind of the cornerstone of this concept, Becoming Your Own Banker, Unlock the Infinite Banking Concept by R. Nelson Nash. That's a great book, by the way. He's the one that coined the whole phrase infinite banking. And then Chris Naugle and Brent Kessler, my two friends and mentors, they talk about it in their book, Mapping Out the Millionaire Mystery. And then, of course, Chris has the Private Money Guide, which is how to use this concept for private lending. Other thing I want you to kind of understand that, as I said, this has been used for a long time. So who else is using this concept in history? So Jim Harbaugh, he was actually paid his bonuses and his salary through this kind of a concept. So the college actually paid him through infinite banking. Very cool. I've talked to a lot of clients about how they did it. Pretty amazing. This guy, he might not remember who he is. I hope he does eventually. But Joe Biden, former president, he actually has multiple policies, 6 of these things as well, with a company called Mass Mutual. His wife disclosed that, by the way. Walt Disney, so kind of a cool story. He couldn't get any banks to finance the beginning of Disneyland, so he went and financed it himself through his own bank, Infinite Banking. That's how Disneyland got its start. Ray Kroc, when he was growing McDonald's with the McDonald's brothers before he took it over, I mean, he did take it over eventually. He was actually paying salaries and the growth through Infinite Banking through this strategy by being his own bank. Pampered Chef, she actually started Pampered Chef with a small amount from one of these the strategies. So it's kind of cool. And of course, Warren Buffett acquired that for a very large amount of money. It's worth a huge amount today. And then, of course, a lot of wealthy families, and I've spoken to a lot of families, wealthy ones that do this, but the JPs, Morgans, Chases, Vanderbilts, the Rockefellers, they all do this. And of course, you can do this as well. All right, now I want you to understand a couple of things here. What will infinite banking do for you? What can it do? So these are the things that it does. So one, it guarantees generational wealth day one. Not like other strategies. This does it day one, guaranteed tax-free, by the way. It allows your money to grow uninterrupted, compounded for the rest of your life with guarantees, by the way. I love guarantees, by the way. So it does that. It takes control of your money away from the big banks and puts that control into your hands. Like I mentioned at the beginning, we want to control our money. This is a very good way to do that. It protects your money from lawsuits, from bankruptcy, divorce, court orders, and creditors in most states, by the way, which is a huge deal. But the main thing that it does that we love to focus on is it allows you to be the bank for things that you may normally use a traditional bank for, such as real estate investing, college, cars, homes, investments, retirement, even, still having all the same benefits listed above. All right, so one thing I want to mention, this is kind of a fun slide, and this is a great video if you ever want to go check it out. It's called the backwards bicycle. You can go Google it. It's on YouTube. It's hilarious. Do it after the presentation. But think about this. Who learns quickly? Well, kids. Kids learn very quickly. They learn how to ride a bike when they're young, and when you're older, guess what? Hop on the bike, you can still ride it typically, right? It's still easy to ride because you retain that. That's mindset. It's your memory, that you've learned. Now, here's the thing though. What if you had the backwards bicycle? Now, the backwards bicycle is pretty crazy because when you get on it and you turn the handlebars to the left, the wheel goes to the right. And on the video, the guy's trying to ride this thing and he's falling over himself. He can't ride this thing. So it takes him quite a bit of time to learn how to ride the backwards bicycle because he's having to reprogram his mindset or what he's learned before. Okay. But once he learns how to ride the backwards bicycle, he can ride it. But here's the crazy thing. When he gets back on the regular bicycle, he cannot ride the regular one anymore. So what happened? He reprogrammed himself. So that's the same thing. It's an analogy, by the way. It's the same thing around money. We're taught a certain way around money. Now, I'm going to challenge you with that mindset. Now, once you learn a new way of how money works, it's very, very hard to go back to the old way or the regular bicycle. But the old way of thinking about money, because you've been reprogrammed or you've learned a new thing, it's very hard to go back. So that's what we're going to be talking about here. But the one thing we're going to be talking about importantly is, where does your money go first? Most people, it goes out the door, banks, it goes to credit cards, it goes to debts, all that kind of stuff. So we're going to talk about, where does your money go first in this presentation. Let's kind of talk through about the first, before we get into how infinite banking is going to work for you. Why aren't more people successful? Now, because this is a way to change that. Infinite banking can really change that. So I call this the mysteries of money. What kills wealth? Well, taxes. Like I always say, I'm okay paying taxes, but I'm a lot happier paying less, right? So taxes. Inflation, the hidden tax they call that. Inflating of the money supply. Two causes: the Federal Reserve and the banking system. So there we go. Volatility, so the ups and downs of markets or investments. Interest, the average household pays over $18,000 of interest as before COVID, by the way. It's probably higher now, but interest destroys wealth. Mindset, what destroys your mindset around money or success? Following the status quo. Fear or FOMO, fear of missing out, right? Life in general, what we're taught, especially what we're taught, really can make us successful or have the opposite effect. Now, really quick, let's kind of talk about some quick definitions here. What's the definition of money? It's just a means of exchange. Think of it like just like it could be seashells, it could be rocks, it could be dollar bills. It's just a means of exchange. What company uses compound interest? Now, people say banks, but banks don't typically use compound interest. No business really does. So we're going to be talking about compound interest and how you can use it as your own bank. Are your dollars worth more today or in the future? Obviously, we know that our dollars are worth more today than they are in the future, because if you go 20 years into the past, how much candy could a $10 bill buy you at a candy store? Bagfuls, right? What about today? Maybe half a bag, maybe a little tiny bit, not very much, right? So your money is worth more today than in the future. So knowing that, Taxes. Are taxes going to go up or down? Well, they've typically always gone up eventually. They don't typically go down, they go up. And then a question to think about this is, would you wait to eat bread or drink milk? What do I mean when I say that? Would you go and buy bread or milk and then put it into the freezer and maybe now having one loaf, you have two, but it's 5 years down the road and it's freezer burned. Now would you eat it? Well, no, of course not. You really wouldn't do that. You wouldn't do that. You'd do it now. But here's the thing. What about your retirement account? So with your retirement account, you're actually putting money into that thing and you're going to wait to use it down the road, which is kind of strange. So here's another way to think about this. Would you go and buy a car like a Honda Accord, something that's not going to go up in value very much, and put it in your garage and then wait 5 years to drive it? Of course not, right? You wouldn't do that. But why would you do that with your money then? That's the crazy thing. We do things with money that we wouldn't do with things that money buys. Think about that for a second. So your retirement account is essentially doing the opposite of that. You're not using it today, you're waiting to use it down the road. So think of it like buying grain. Would you want to pay taxes on the grain or the harvest? You buy $5,000 of grain and you sell it for $50,000. Which one do you want to pay taxes on? Most people will say the grain, which is correct, in my opinion. But guess what? Your retirement accounts, like a 401k, are the opposite of that. So very interesting. Let's look at how money flows. Now, this is a good example of how like banks work and with a typical transaction. So let's look at a car as an example, buying a car. Let's say we're going to go buy a $25,000 car. Doesn't matter what kind of car it is. Could be, a cheap Ferrari or a very expensive Honda. Doesn't really matter. Okay. Now let's say that at the local bank, you've got $25,000 in the bank and you're going to go take that cash out of the bank and you're going to go buy the car for cash. People say, oh, that's great if you can do that. Well, let's think about that for a second. Now, let's say you go to the bank and the banker Bob, whomever he is, says, hey, wait a second, Brian, before you do this, how about we do something different? Instead of taking the cash out of the bank, how about I do this? How about I give you a loan for $25,000? You leave your money in the bank as the collateral. I pay you 4% on the money you leave here, and I give you a 6% loan. Okay, so once again, so you're going to leave the money in the bank at 4%, but you're going to get a loan at 6%. And let's say it's going to be a 5-year loan, 60 months. What does the math show us? Is that a good decision to make right there? Well, your monthly payment on the car note or loan is $483. Okay, that means that your future payments, all added up, will be $28,999. That's how much you're going to be out of pocket. But guess what? The future value of the money in the bank is $30,525 because you're earning compound and you're paying simple. You've made $1,526. That makes sense to make money, right? Now, someone might say, well, Brian, but I paid cash. I don't have to make any payments if I pay cash. Well, I'll pose this to you. How did you get the $25,000 in the first place? I saved it up over time. Every month I put some money in there. Okay, if you pay cash for a car, would you not maybe save money every month in the future to replenish that cash savings again? Yeah, I'd probably do that. Okay, this is nothing different. It's the exact same cash flow then, except you made more money. Now, this is when you use a traditional bank though. What we're going to be talking about is how can you be the bank and the borrower? You own everything on the page right here. There is no other bank involved because you are the bank. So you get the benefits. That's what we're going to be talking about. All right. So the money multiplier method. So let's talk about that. So there's 3 parts we're going to be talking about here. So one is going to be the machine. What is the machine that makes this thing work? The marathon. Okay, this is a marathon, not a sprint. Building wealth, right, is not a sprint, marathon. And the last one, the millionaire. How do you build wealth with this concept, with infinite banking? All right, let's get into the machine. So what is the machine? So here's what I want you to think about. Think of like infinite banking, this concept, like a car. A car has all these features. It's got tires and wheels and brakes and radios and all that kind of stuff. But guess what it also has? What makes it go down the road? An engine. Now, when you go buy a car, you care about the engine, how many cylinders, how much power, what's the gas mileage, all that kind of stuff. But once you've had the car for, a few months usually, or a few years, you don't really think about the engine all that much anymore in most cases, right? But you have to have the engine. So we're going to talk about the engine to get this going. So what is that engine? It is nothing more than a permanent dividend-paying whole life insurance policy, specially designed, by the way, from a mutual insurance company. Now, there's only a handful of companies that can do this. And there's only a handful of basic people that can really do these kinds of policies when it comes to the brokers, things like that. So that's what that is right there. And you might be saying, well, why life insurance? Well, it is the best engine that makes this car go down the road as efficient as possible. That's why. So this is what we use. I remember when I first heard about this, by the way, when I first heard about infinite banking, I was like, I don't need life insurance. I wish someone had told me or like knocked me upside the head when I said that years and years ago because I was wrong. I definitely wish I had done this back then when I first heard about it, but I did get into it later on. I want you to think about this as well. You might say, well, why life insurance? Well, guess who's the biggest buyer of whole life policies? Not IULs, not VULs, it's whole life. It's banks, traditional banks. Traditional banks buy more whole life or own more whole life insurance than they do all of their real estate and buildings combined. Combined. Traditional banks, by the way. So we're going to be doing the same things the banks are doing with our money already. Think about that for a second. Pretty crazy. Jay, yes, key employee insurance is part of what it is. It's called BOLI, bank-owned life insurance. You can go look it up online, but that's what it's called. It's a special kind of insurance, but it's whole life. But yeah, key employee insurance is part of how they do that. They have policies on executives, presidents, CEOs, managers, etc. They own billions and billions and billions of this. And also, they have quadrupled their holdings of life insurance since 2016. All right, so to understand, the machine, we've got to understand how our money flows. So I showed you here how you can make more money when you're earning 4% while paying 6%. Now, why is that? It's because you are the bank in this situation. You're on both sides of the equation, not just on one side. So to understand how that works, let's look at how a bank actually functions. What do they do? So when you give money to a bank, let's say 100 grand at 4%, is that a liability or an asset for that bank? Well, it's a liability because they owe you that money plus the 4%. But they don't just sit on your money. They don't put it into a vault in the back and just look at it. They put it to work. Money in motion makes money. So what do? Home loan, 7%. What's the home seller do with that money? Okay. They take that money and put it right back into a bank. What's the bank do? Same thing, puts it right back out. Maybe 8% on a car note. What's the car company do? Puts the money back through a bank. They pay their employees. Where did that money go? Back into a bank. What's the bank do? Maybe it's a home remodel loan, construction loan at 9%. What's the contractor do? What do the subcontractors' employees do? Put it back into a bank again. What's the bank do? Puts it back out on a debt consolidation loan, maybe at 12%. Credit card companies put it right back into the bank. So what they do is they put your money into perpetual motion. It's always moving, always moving, always moving. So what's that mean? It means they make 500% more on your money than they're actually paying you on that money. Now, if you're saying, well, is that what they do? Yes. Go look it up. It's called BauerFinancial.com. Banks make between 400 and 1,300% on the money you leave in their hands. They do that because they're in control of your money. And by the way, when you deposit money into a bank, it's really not your money anymore. Contractually, if you can look at the fine print, they control your money now. They can do pretty much what they want with it within obviously legal limits, but that's what they do. So yeah, it's kind of funny. Whenever I go to a bank and I see those little suckers next to the kiosk with the teller, bank teller, the little dum-dums, I'm like, dum-dums, huh? Always makes me laugh because I know what the banks are really doing. So I want you to understand also how we handle money and what are we taught around money. So let's look at how we spend money or the average pattern of how money is spent in the average household. So let's look at a dollar bill. So every dollar bill that comes into your hands or your account goes out. So where's it go? Around 20 cents goes to automobiles, gas, tires, upkeep, payments, that kind of stuff. Around 30 cents goes to housing, rent, mortgage, that kind of stuff. 40 cents of every dollar goes for everything else, food, clothing, shelter, entertainment, travel. There you go. That's 90 cents right there. So 90 cents of every dollar that comes into your hands goes right back out to somebody else. And what's left over? Maybe 10%. So 10% is maybe left in savings. So here's what I'm going to do. I'm going to talk about not the savings, which by the way is what a traditional financial planner typically talks about is your savings. No, no, no. We want to talk about the other 90 cents. How can you gain back control of part of that money right there? So let's look at interest. Okay, so I'm not going to talk about the savings. So automobiles, 20 cents of every dollar goes out to automobiles, but here's the thing. 5 cents of that is interest. So what if we recaptured that interest back into our savings? Let's go ahead and do that. 5 cents right there. Okay. The next thing, housing. Well, 30 cents goes out to housing, but 25 cents of that is interest. If you think of an amortized mortgage, the majority of it is interest, which is crazy, by the way. So what if you could recapture some of that interest and put it back into savings because you now are the bank? There we go. Capture some of that. Now, everything else, travel, et cetera, things you might use credit cards for. Around 40 cents of that goes out to that, but 5 cents of that is interest. So let's capture that 5 cents back into our savings. So that's what we're talking about doing right there. We're talking about recapturing these functions, these banking functions in our lives so that we can recapture the interest that typically goes out to somebody else, but now we get that benefit. So that's really what we're going to be talking about with the infinite banking concept. So now I want to show you some actual examples of how this can work in your life. So I'm going to look at a car example. I love classic cars. I don't have my Mustang anymore. I have a 67 Mercury Cougar. That's what I have now. But we're going to look at how we can get all the money back for every car that you ever buy, drive, and own because most of us have bought a car. All right, real quick, let's look under the hood of infinite banking policy. So you'll see over here, I'm going to get out my laser pointer thing. Where's it at? There it is. Okay, so you're going to see a thing called deposits right here. Now, those are premiums. Now, we call them premium deposits because when you deposit money into these policies, you get what is called cash value every deposit that you can use and borrow back out. You can borrow against that cash value. So we call them premium deposits. The next thing I'm going to show you is age. So you're going to see age over here. People say, oh, am I too old? Yes, there is an age where it becomes challenging, but generally age is not much of an impact because we're not focusing on death benefit. This is living benefits. So age does not typically matter. You can always do policies on somebody else, by the way, if you want to get someone who's more insurable, that kind of stuff. But we're not going to focus on death benefit. Also, a lot of people say, oh, how much death benefit am I buying? You're not buying death benefit. We're funding the policy to use the cash value to become our own bank. That is what is going on. So we're not going to be talking about the death benefit until the end. I'll talk about it a bit at the very end. We're going to be focusing on how we use the policy while we're alive, called the living benefits. All right. So let's look at how this is going to function. So we're going to take a policy, we're going to deposit $10,000 per year into this policy, this infinite banking policy. Now, $10,000 is just an arbitrary number for this example. It could be more, it could be less. It depends on the person. So I'm just using this as an example. And this is just the simplest way of funding a policy. There's more ways to fund it, by the way, which I'll get into later on. You can really get the cash value very high, very early on. I want to say with a very simple example so we can get the concept down first. All right, so 10,000 goes in. Now what happens is you'll see over here, we're getting cash value every single deposit. Now these are very, very ultra conservative numbers. The ones that we typically build are going to have more cash value. But once again, I want to be very simplistic here and just paint the picture with a very conservative example. Now, let's say at the end of year 3, you want to go get some cash or some cash value out and go buy a car. That's what you do. So that's called a policy loan. That's a guaranteed loan. So in this example, we go get $25,000 out of our policy at the end of year 3 and we go buy the car. But here's the thing. You're going to be a responsible banker, right? So you're going to go pay back your bank. Okay. And we're going to do that at, let's say, $500 per month, 5-year note. So what's that look like? That's $6,000 per year, $500 per month, right? We're going to pay that loan back because we are going to be responsible. So what does the math look like? Well, you've put in $70,000 right here of total deposits. You've paid back $30,000. So that's $100,000 that has been paid out. Yet here's the thing. Keep in mind, you had $25,000 of cash that you got out. So how much has really gone into this infinite banking policy? $75,000. But if you look here, you have $67,000 of cash value inside this policy. Once again, conservative number. You put in 75, but you have 67. That means that you've recaptured 91 cents of every dollar so far. 91 cents you've recaptured. But here's where it gets very powerful. So let's look at years 8 through 12. Now in years 8 through 12, this example or this person, let's just say, decides, I don't want to pay any more premiums into this policy. Now, typically we would want to do that because it keeps the funding going, keeps it growing faster. But let's say they said, hey, I don't want to. You have that ability, by the way. You can always turn off the premiums after typically 7 years. So this person does that. But guess what? The growth doesn't stop. The policy keeps on growing. Even though you're not funding it anymore, your bank grows even more. So what's that look like? Well, the cash flow keeps going up. But let's say that you have maybe a daughter. So I have a daughter who's turning 15 here next month. Oh, it's getting kind of scary. We're going to go buy another car. Maybe get her a car for $25,000 in year 8. We do the exact same thing though. We pay ourselves back. So what does that look like? $6,000 per year, 500 per month. Once again, same thing. So what happened in years 8 through 12? Well, we put nothing in the premiums into the policy, no deposits, but we did pay back the policy loan at $30,000. Okay. So what's that look like now at the end of year 12? We've put in 20 or 30. We've taken out 25,000. So we've actually literally put in $5,000 into this policy in those years. But look at this. Between years 7 and years 12, it grew by $23,592. But here's another very, very important thing to look at. How much have you put into this policy now? How much have you put into it so far? 75,000 years 1 through 7, and then 5,000 years 8 through 12. That's $80,000. How much is the policy worth as far as the cash value goes? $91,000. So you've actually gained in the policy $11,000 and change, but you also own 2 cars outright. So your net worth has gone up and you own 2 cars outright. So that's just a simple example, conservatively, of how infinite banking can work for buying your cars right there. Very simple example. Okay. Now there's 3 rules when it comes to infinite banking that we like to follow. Pay yourself first. Okay. Make sure that you recapture and then recycle your money. So what are those 3 rules? Pay yourself first. Where does your money go first? We've always been trained to pay other people first. Pay your bills, pay the credit card companies, pay the banks, everybody else. Number 1 rule, pay yourself first. Number 2, pay yourself with interest. Okay. If you're going to pay yourself back with interest. If you're going to pay a bank loan, you'll pay that back with interest, right? So treat yourself the same way. And then, of course, recycle and recapture your money. What does that mean? Keep your money moving. Keep your money in motion. Recycle and recapture that money. That's really what makes this thing powerful, because the more you do that, the more you get on the back end. All right, so this works for a car. What else does it work for? So what are the number 1 things that a lot of people use infinite banking for? And by the way, all of us here at the Money Multiplier, most of us have done this as well, is debts. Debts are one of the things that steal so much wealth in this world, because we just keep getting into debt. It's that perpetual debt cycle. So I'm going to give you an example. This is a very powerful one and a big one of how you can recapture and pay off debts faster, because there's 2 kind of rules, or 2 steps to building wealth. 1, get rid of the bad debt first, right? Number 2, put that money to work. So this is that first step. All right, so in this example, this is a 45-year-old doctor, chiropractor. I believe he's a chiropractor. This is a conservative example, by the way, as well. Now, this person has 9 third-party debts. Total debts are $478,000 and change. And that's a big amount of debt. Total payments on those are $5,777 per month, or $69,000 per year. Now, granted, this is a doctor with a lot of debt, so keep that in mind. But yes, that is a lot of money going out the door right there. So this doctor came and said, hey, I want to set up a policy. So he's going to put, and by the way, it takes him 19 years to pay all that off if he did it traditionally. Okay, so what's he going to do? So we're going to open up a policy. It's going to be $25,000 deposits. So he's going to do an annual premium at the beginning of every year of $25,000. Now you might be saying, Brian, well, I can't do 25. Well, keep in mind, that's just his number. Your number is going to be different. The other thing you might be saying, well, Brian, well, where is he getting $25,000? I don't have a lot of extra disposable income, maybe, as an example. Well, this doctor, by the way, was putting money into retirement vehicles, IRAs, 401ks, that kind of stuff. But he wasn't very happy with the performance of those vehicles. So he decided, I'm going to divert some of the money that's going over here to those buckets into the infinite banking bucket. So his cash flow really did not change at all. It just changed from where he was putting it. Okay, so that's what happened there. All right, so when he puts that first deposit in year 1, he has immediate access within 30 days to around $14,863 of cash value. Now, once again, that's a very conservative number. The ones that I would build, or that we have built, they're probably more like $20,000 day 1, maybe even a bit more. But here's what happens. So he immediately goes to his bank and he gets a guaranteed loan, doesn't even have to ask permission, guaranteed. And he pulls out that $14,000 as a policy loan, and he pays off the Discover card, the Lowe's card, and part of the Nordstrom card. Must be doing a lot of shopping right there. Okay. Now, what happens to his monthly premiums? Well, they dropped by $448 per month. Okay. So now, what does he do with that $448? Well, he does not just go and spend the $448. He recaptures that money. Remember, rule 3, recapture and recycle. He's going to recapture that $448 into his hands. He's going to control it. So he's going to take that money and hold it aside. So now what does year 2 look like? Well, once again, year 2, now by the way, he's also been maintaining the payments every month on the remaining debt. So the debts are also going down because of the minimum payments there. Year 2, Another 25,000 goes into the policy. The cash value now increases by $16,571, and the payments of 448 that he's holding back and controlling are worth 5,374. So how much does he have available at the beginning of year two? 21,945. So what's he do? Takes that money back out, puts it to work by paying off the Nordstrom card, Wells Fargo, private loan, and part of the BMW, maybe a car, maybe a nice motorcycle, who knows? And his debts drop. But also his monthly payments drop. So now he's actually recaptured $1,917. Every month, by the way, he can now controls that money. He's going to recapture it. So year three, same thing happens. 25 goes in, but now the cash value jumped up by $25,000 and change. The payments of $1,917 back to himself are worth $48,545. It's getting bigger and bigger. See how this works? He borrows that back out, wipes out BMW, wipes out West Marine, probably a boat, and wipes out part of the condo. His monthly payments have now dropped by $3,677. He's recaptured that much money now, so he controls that. So that's what's going on. Now I'm going to pause here because remember the marathon. This is the marathon method. How much has he put in? 25, 25, 25, $75,000. How much has he taken out? Around $55,000, by the way. So how much is left in the policy? Now, one thing I haven't talked about yet, these policies, they earn dividends. That's why it's growing and compounding. Those are the uninterrupted compounding. So how much is he earning those dividends on? Is it 75? Is it 55? Is it $20,000? Because that's what he's taking. That's the delta. No, it's the full $75,000, by the way. Roughly speaking, he's earning dividends on the full amount, even though he's taken that money out. So it's uninterrupted growth. It's amazing. All right, let's get back to it. So year four, once again, 25 goes in, cash value jumps up by 26,000 and change. The payments are 3,677 back to himself is 44,000. So the total cash that he now has is $70,000 and change. Same thing. He borrows that money out and he pays off a chunk of the condo. Now, what happens right now is nothing changes. The payments don't change because the condo and the house are amortized loans. With amortized loans, when you pay the principal down, the payments do not change. So the monthly payments don't change. Keep that in mind. In year five, he puts in another 25. Cash value goes up by 27. Payments back to himself are 44,000. Total cash is 71,000 and change. Now he wipes out the entire condo and a big chunk of the house. Now his monthly payments have dropped by $4,556. Okay, so now here's something kind of crazy. So in year six, the chiropractor said, "Hey, you know what? This is amazing. I want to do more of these policies. I want to open up another branch of my bank, so to speak." So what's he do? So he chooses in year six to drop the premiums on the first policy down to $10,000 instead of 25. You have that option if you want. So he does that. So you can see it right here. So he drops it down to $10,000, but guess what? The cash value goes up by $13,000, $92, or $13,000 and change. The second policy he puts in, it's the same one. $25,000 goes in, $14,863 of cash value available right off the bat. So and then the payments of this 4,556 back to himself is $54,000. Total cash is now $82,000, and the condo is $76,000. So what does he do? He wipes out the condo. His debt payments are now zero, and he fully controls all that money. Now, the next phase is in year seven. In year seven, he takes the full 5,000. Actually, by the way, it's year six and then part of year seven. He takes the 5,777 and he pays back his policy loan, his banking system. He pays himself back, or he pays back the bank with interest, of course. And at the end or mid year seven, he's completely debt free, and he has multiple six figures of cash value available in the policy to put to work, creating more assets to the cash flow. So that was a mouthful right there. So let me kind of rephrase that. So this doctor paid off all of his debts in about 7.5 years. Well, 6.5. Well, yeah, 7.5 years. 7.5 years instead of 19 years, and he recaptured over about $200,000 of cash value in the policy that he would have otherwise paid out to the creditors. And now he can put that money to work, whether it's paying for college, buying real estate, investing it into his business, whatever he wants, because now he is his own banking system. Now you might be saying, "Well, Brian, that sounds very complicated. There's a lot of steps. How do I do that?" We show you how to do it. We have software that you can use that will actually map out how to pay off the debts, and even other software. We have other softwares that do velocity banking, infinite banking, loans, investing, all sorts of other stuff too. So we have a lot of other resources. We also have what's called an implementation team that helps you do exactly what I just showed you. So someone's going to hold your hand, by the way, to map that whole thing out. So, but I want you to understand how quickly you can actually recoup that debt back into your control, and then pay it down, and then put that money to work. It's a huge mindset shift for a lot of people. So, the millionaire method. This is the third part. The third part. What if I have no debt? Well, okay. What if you got rid of the debt and now you have no debt? What's the next phase? What if I don't need that new car? What if I already have a car? I've already paid it off, whatever. Can I still benefit from privatized banking? Should I become my own banker? Well, absolutely yes, because guess what? This is where the fun really begins. This is where you start to really build wealth. This is when you start to replace your income with cash flow, and like someone else on this call, quit your job, right? You can do that. So what are some things that once the debts are gone, you don't need that new car, what else can you do with infinite banking? So here are some things that you can do. These are we have a lot of our clients doing a lot of these things. So real estate investing, so wholesalers, flippers, buy and holds. I've done a lot of real estate. I wish I had had this concept in place when I was doing those kind of things. It would have been a game changer. Commercial properties, so apartments and mobile homes, private lending, passive real estate, by the way. Business owners, we have a lot of business owners. Stocks and options traders are doing this. We have people even doing Bitcoin, strategically, by the way. Startups, equipment flipping, all sorts of things. Okay. Dex says my vacation. Yes, a lot of people use infinite banking to pay for a vacation, and then they pay themselves back instead of using a credit card, and you're the one in control. So lots of things like that. So what I want to do now, this is kind of fun. I want to show you an example of an actual policy. This is a real policy, and combining that policy with private lending on real estate. So you're going to be a lender on someone else's real estate deal. So in this policy, in this example here, this person is going to do a $50,000 per year premium. Now, once again, this is just this example, okay? Your numbers are your own numbers. Now, you're also going to see right here, see in year one, the contract premium is $150,000. Why is that? Well, you have the option, if you want, typically at the beginning, you can do what's called a dump in. It's an overfunding of the policy. This person did $100,000 into the policy day one in addition to the premium. That's called a dump in, that 100,000. But you get immediate access to around 90 to 90 a little more cash value from that dump in within 30 days. So they can put it to work immediately. So that's what this person did. So what I want to do, though, I want to fast forward down the road. So let's look at down the road. Let's look at year 8 as an example. Okay. In year 8, the cash value went up by $66,000 and change. So their banking system, it grew by that amount of money. That's how much they have available. How much cash did they put in? Well, they only put in $48,593 into this policy at year 8. This is how these policies become efficient down the road. The longer they're in place, the more and more efficient they become. So that's a growth of $18,129 or 37% cash on cash return. Who here would like to have a 37% cash on cash return on their money? Okay, let's make it even better. All right. So let's say that person took that money out. They can borrow, by the way, $531,000, right? They borrow that out of the policy and they private lend it to an investor at 12%. And let's say the bank, their bank themselves, or the insurance company, by the way, is going to charge 5% on that loan. What's the math? 12% private lending plus 37% already in the policy, less the 5%, equals 44% cash on cash return. Not 37, but 44%. Because why? They put the money to work. That's what they did. So we did nothing different with this person other than where their money went first. That's it. It went somewhere first through this. Here's the question. Would you rather make 12% private lending? And by the way, I've had private lenders that see me do this math and they're like, oh my gosh, because they've been private lending for years. I go, yeah, I'm making 12%. It's great. Then they said, I've been lending for 10 years. If I had done this instead, and I'm still private lending, I'd be making 44%. I mean, they're kind of like, they're like in shock a little bit. But yes, 12% or 44%, be your own banker. And so how do they grow this fast? It's just uninterrupted compounding. So when you borrow from the policy, that's called a policy loan, you still earn the exact same dividends. The growth does not stop. It is not interrupted. It continues to go up no matter what. You borrow or not from your banking system, it still grows uninterrupted. That is one of the more powerful things of infinite banking. And you can see how this works over time. In this example, this person put in a $50,000 lump sum and they're putting in around $6,000 per year as well. Okay. Look at the numbers here. Cash on cash, 21% at year 2, 54% year 10, 115% year 15. Access to capital, 126% year 5. Year 10 is 154%. Year 15 is 215%. You want to get real crazy, look at 30 years down the road. Triple digits. I mean, it is amazing. Longer it's in place, the more powerful it becomes. All right. So how do you do that? How do you build that kind of wealth? Well, you kind of just saw it right there. It's the same way you eat an elephant. Now, I've never eaten an elephant. I don't plan on eating one, but if I did, it would have to be one bite at a time. And then the other analogy I like is the man at the top of the mountain didn't just fall there. He climbed up there. But yet here's the thing. A lot of us look at somebody else who is successful, who is at the top of the mountain. Oh, I want to be there, man. They're so lucky they got there. But we don't see the journey. Like that person decided to stop walking around the mountain and he started to climb the mountain. So infinite banking is kind of the same way. You got to start somewhere, but you'll eventually be at the top of the mountain. But it starts with taking that first step, or in the elephant example, that first bite. All right. Is it possible to owe no man, tongue twister, is it possible to owe no man nothing? Well, maybe, maybe not. But the machine of infinite banking, it works for debts and expenses and everything else. It works for pretty much anything. So we have a lot of people, by the way, that do it for taxes. So for me, by the way, I don't pay my taxes monthly or anything like that for my house or because my house is actually owner financed. So I actually use a policy. I pay the interest or the insurance and taxes, and then I pay myself back every month. So I cycle it through the policy. That's how I do it. So I use it. So when you buy a house, you pay a lot of money to a bank. If you use the chiropractor example and you went and bought the house, you'd pay the banks $493,000. If this person was able to finance the entire thing through their banking system, they would actually earn $750,000 and own the house and the condo outright. By the way, that's a swing of over $1 million. So ultimately, that's the power of infinite banking. It's that swing. So this example, if he had bought those homes with his banking policies instead of using a bank, he would have made over $1 million instead of paying $493,000. Pretty powerful. I also want to show this little screen. You probably can't see this, but we have software that maps out how to put your money to work. So like if you're going to go do an investment, a real estate deal, that kind of stuff, we will map out the best way and the most efficient way possible to structure that strategy with infinite banking. So really cool, really cool. So now that you know that how this works, you think that everybody should do this? Absolutely. Because if you're not doing this, you're not benefiting, by the way, the next generation, which I'm going to talk about here in just a moment. But here's the thing. So to do infinite banking is a privilege. It's a amazing privilege. And why do I say that? Well, a lot of people say that it sounds too good to be true, but only around 10% of the population can do this. And if you want to know why, I'll share why, but about 10% can do this. So if you're here, you're probably one of those 10%, by the way. So I got some more slides to go through. I'm going to show some more examples, give you some more real life examples of how infinite banking has worked. I'm going to go through a lot of the kind of the other aspects of how it functions and things that you're going to really want to know about. But I want to put this up right now. So if you want to, schedule a call with me, go through, more questions, go through how this can work for you, go through your situation and how it can solve that. You just go to brian.brobanker.com/TBCT. But I love this example because this is the switch that you want to make. Stop working so hard for your money and get your money working for you. Like that is the big switch right there. All right, so now I want to share some things that infinite banking really does that just set it on fire in a good way, by the way. So by the way, so some things that I didn't talk about yet, which I'm going to talk about. So one is the death benefit. I'm going to cover that real briefly. The loans. Okay, the loans that you borrow are your loans. I'm going to cover how they function because they do not have to be repaid, by the way. The internal values go tax-free. So as I said, I don't mind paying taxes, but I'm happier paying less. These grow tax-free, which is amazing. The policies are exempt from judgments and liens in most states, by the way. Not all states, but most states, and I can tell you which ones if you have a question about that. You can create tax-free retirement with this concept. Tax-free retirement. That's awesome, by the way. Pretty much nothing else can say that, except for maybe a Roth IRA, by the way. So death benefit. So look at the death benefit over here. So this is it's not unique to infinite banking, but it's unique to special kinds of permanent insurance. But you'll see right here, this policy starts out at $325,000. But look at year 2, 364, 403, 443, boom, boom, boom. It just keeps on going up. So that keeps growing. But that, by the way, is guaranteed and is tax-free if something happens, hopefully not early in this person's life. But check this out. This is a female, age 42, non-smoker, okay? She wants to put in $20,000 for 5 years. By the way, this is a real policy. This is a real client of mine. She wants to put in $20,000 for 5 years and then put in less after that. So you can see we drop it down to $3,257 after year 5. But guess what happens? In year 1, she puts in 20. The death benefit is $325,000. If something, God forbid, happened to her, she's going to put in 20, but her beneficiaries get $325,000. But look at this. Now it's year 4 or 5. She's put in, or yeah. So year 4 is 180,000, and then year 5 is $100,000 has gone in. But the death benefit is $483,000, almost 5 times what she's put into it. And that death benefit will always grow, and it will never be less than what you put into it, or less than the cash value, by the way. It's always going to be more. So you're gonna multiply your wealth multiple times over for that next generation. So if you understand that one thing right there, you'll understand why wealthy people do this concept on every single person in their family when they're born. Because they know that they're going to grow their wealth 10 to 15x every single generation, tax-free and guaranteed. Generational wealth is a very powerful aspect of infinite banking. We don't tend to really focus on it because of the death benefit, but it is one of the big benefits of this kind of a strategy. So there you go. All right, I'm going to talk about policy loans here for a second. So policy loans are guaranteed, okay? Ask and you shall receive. There is no credit check. There's no approval. So keep that in mind. There is no approval, okay? You log in, type in how much you want. It shows up in your account a couple days later. Pretty simple. And we show you how to do all that stuff. The loans are private, by the way, too. So they don't show up on your credit report. So they don't impact your credit score or nothing like that. It's a private loan, essentially. There are no payments back on the policy loan. There is no monthly. You are the one in control. So you're the one in control. So if you miss a payment, well, you don't even have to make a payment, so nothing happens. Now, I want to also explain one other thing that's very powerful. You can choose when and how to make a payment back. But with these companies, they only charge the interest on the policy loans once a year. They apply it to your loan, by the way. So if you do make a payment back at any point, 100% of that payment goes to what? Principal, which means you can manipulate the actual interest rate that you're actually receiving because you're paying down principal only, because they charge interest once a year. Now, if you don't know what that means, schedule a call with me and I'll explain it in a bit more details, but that is an incredible thing. I don't know any other type of financial loan vehicles that do this. It's incredible. Next question I get quite a bit is, how can I fund my infinite banking policy? Okay, there's a couple different ways. So one, the premium deposit. That can be done monthly, can be done quarterly, can be done annual, and you can switch that up, by the way, during the life of the policy. What's the minimum that I can do to get this going if maybe my cash was tight? What's the minimum? 10 times your age per month. 20 years old, 200. 50 years old, 500 per month. What's the maximum? The maximum depends on the individual, but generally speaking, between 20% and 25% of your gross revenue or gross income, including business revenue and investment income, is your annual divided by 12 for monthly. So if you didn't catch that, that's fine. Schedule a call with me and I'll go through those numbers for your situation. Okay, so on top of the premium deposit, which is the one that goes in monthly, quarterly, annually. And by the way, that premium is not for life. It cannot go up. It can actually go down and it can go to zero. Okay, I think I showed some examples of that already. You can put in what's called a dump in. So let's say you're putting in 10,000 per year. You can put in at the very beginning 5, 10, 15, 20, 30, $50,000 into the policy. It's called a dump in, and get access to 90% of that within 30 days. It makes the policies very powerful. We call that a dump in. And then right around 50 to 90% at the very beginning, by the way, goes to the cash value within 30 days. Depends on how you fund it and stuff like that. But a lot of it goes to the cash value, and it can be even more. So there you go. So the question is, well, okay, why would I do this? Well, as I showed you down the road, these things are going to be worth way more than you put into it. So let me show you an example of what that looks like. And this is a real life illustration. This is a female, age 32. So this female's putting in $10,000 per year right here, and a $50,000 dump in or lump sum right there. So what does she have access to? She puts in 60 at year 1. Now this is end of year numbers, so this includes dividends. So at the end of the year, she has access to $55,000 and change of the what she's put into it. Is a 92%. 92% into this policy that she has access to. That's just year one, by the way. But look at this. In year two, this person puts in $10,000 year two. At the end of year two, the cash value has increased by $10,607, more than she put into it. She is already cash on cash positive because she did that dump it. But let's go down the road a bit. Let's look at year 11. So now the premiums are going down, right? Because she wants to do that. It's her choice. In year 11, she puts in $3,120, but the cash value goes up by $10,590. Cash on cash return. Pretty powerful. Also, keep this in mind. At year 11, this person had put in $151,000. The cash value, what you can borrow out, is $185,000. Now, here's the crazy thing. She's been able to borrow against that cash value during the life of this policy, and the numbers are pretty much the same as you see here. So she's investing the money and creating more cash flow. Her numbers and wealth are even higher. Pretty amazing. Now, here's a Warren Buffett quote that I shared. It says, if poor people would just do what rich people do, they wouldn't be poor anymore. I don't like that quote as much. I like to change it up. It says, if the poor had the knowledge of the wealthy, they could choose to not be poor anymore. It's a choice. There you go. A question I get quite a bit is also, well, why would I work with you and not Bob over here or my next door neighbor? Well, I've been teaching infinite banking now for 9 years. I got to update that slide. It's 2 years old, but I've been doing it for 9 years, 10 years, something like that. We also have an entire team. So we have over 40 people that are on our team here that set you up, and we only do infinite banking. We are one of, if not the largest producer of infinite banking policies in the US, and that's because we have a lot of referrals, a lot of repeat clients, and the insurance companies really like us because, well, we're their biggest client too. We have like I right now probably have maybe 90 to 100 people in underwriting at any one time. So we do a lot of underwriting. We also have ongoing support and services. During the process of underwriting and after the fact, we have a lot of ongoing resources. We do 6 live events a week. This is one of them, by the way. You're on this one. We do 6 events. Wednesday, we do 3. So there's 3 events we do tomorrow, by the way. I'd recommend checking out if you can. And there's no cost. So you don't ever pay us a dime. We're paid by commission from the insurance companies. There you go. But we don't charge you anything, nothing like that. Yeah, Anna says that. Yeah, keep learning, rewatch different videos, ask questions. Exactly. Yes, we have a lot of content. Our YouTube channel is full of hundreds and hundreds of videos on pretty much every topic on infinite banking you can imagine. Another question I get is IUL or VUL infinite banking? No, it's not. That's it right there. IULs and term insurance pay some of the highest commissions that exist, which is one of the reasons why they're pushed so hard out there. Also, IULs have only been around since the mid 2000s. They're not a tried and true product. Whole life has been around for 200 years, something like that. It's been a long time, or probably longer than that, by the way, but been around a long time. The first policy loan was created in the 1840s or 1830s, something like that. And the first family, the Rockefellers, did infinite banking as they called it privatized banking back then in the 1880s or 90s is when they first started doing what we're talking about. We take about a 70% cut in commission to do infinite banking. So that's why if you go to a traditional financial planner or other traditional life insurance person, they don't want to do infinite banking, or they say that you can't do it or that it's not possible. They don't want to take a 70% cut in commission. We can do that because we have volume, right? But you got to be very careful about that. And we only do infinite banking, by the way. We can also do, yeah, they say, yeah, Anthony says it's a scam. They say that all the time. I have written policies, by the way, for financial planners, life insurance agents, and oh gosh, who else have I done it for? The coaches, Dave Ramsey coaches. So you guys know who Dave Ramsey is? I've had his professional trained coaches come to me to do policies. It's crazy. And we only do infinite banking. Yes. So by the way, so this was like a few weeks ago. I was on a call like this, and someone was talking about IULs, and I said, "Hey, go to Chat GPT, right? Go to Chat GPT and type in, is IUL good for infinite banking?" And it gave them a response. And I said, the next thing you want to type in, do IULs have legal issues versus whole life? And then the next day, the person came back on another live thing and in the chat told me the answer. And it was hilarious because the chat GPT said that no, IULs are not for infinite banking because of X, Y, and Z. They have risk, they have volatility. You can lose the value, you can go to zero. There's fees, all this kind of stuff. And then it said, are there legal issues? Because yes, there are actual class action lawsuits against IUL agents because of how they market them and how they don't perform the way they say they will. So that was the answer it gave. It was pretty funny. Um, all right, so Anna said, yeah, my light bulb was a video that showed that if you earn 2.85% in interest and pays 5.75% on the loan, your money breaks even. So here's a thing to keep in mind. In life, there's only, one of two things will happen. Now, both will happen, by the way, eventually, but we're going to live. So are we better off with or without it? And we're going to die. We know that. Are we better off with or without it? Well, for me, the answer is an absolutely yes, but it has to be a yes for you, by the way. And I'm not going to say that infinite banking is a fit for everybody. It is not a fit for everybody because it can make sense to me for you to do it, but it has to make sense for you before you should do it. Keep that in mind. So a quick little story. So this is kind of my story, my little journey here about infinite banking. So when I first heard about this concept, I didn't really know much about it. I was like, okay, I need to get some life insurance. And I kind of had seen some people talking about infinite banking. But I'm like, okay, you know what? That sounds okay, but I'm going to talk to my friend over here, my buddy. And so I did. And he goes, yeah, I can do a cash value policy for you. And so he that's what he did, right? He went and created it, and I had to go learn about it first. Like I didn't have this kind of presentation or anything to learn from. So I went and did it with him. And he gave me what's called a VUL. I have it sitting somewhere around here, and it is the worst thing ever when it comes to infinite banking. I have lost six figures with this policy. Lost because it was not set up correctly. And actually, if I keep the policy over time, it'll go to zero. I'll lose every penny and lose the death benefit and lose the cash value over time. It is horrible. And once I realized that, that's when I went and found my own mentor. Okay. His name was Patrick, and he was just like me, by the way. He was teaching infinite banking. I learned from him. I went and did it, and it completely changed my life. So I don't recommend the go it alone strategy, like going and use your neighbor Bob. It's very dangerous. That's my experience. Um, Group two is what I recommend, and this is me kind of yes, self-promoting a little bit to be honest, but I had to go through that journey, and you don't want to go through that and have like a bad policy built for you. I have fixed dozens and dozens and dozens and dozens of policies for other people because it got built by somebody else and it was not a good policy. It happens, unfortunately. Yes, there are very many good people out there doing infinite banking, but there's a lot more bad people, in my opinion. So here's the next steps. Just schedule a call. We'll hop on a call. We'll solve your problems. See if infinite banking is a fit. Because here's the thing. Here's the bottom line. When I look at infinite banking, I look at this thing. It gives you control. If you want to give control away to the banks, corporate America, to Wall Street, to everybody else, that's fine. But if you want to build wealth and have control in your life, infinite banking is very powerful. It can be that first step to doing that. But once again, you have to take that first step. And I'm not going to tell you it's a fit for everybody. And if it's not a fit for you, I will definitely tell you. I like to end on this quote from Will Rogers because now it kind of makes a bit more difference or more sense. The problem in America isn't so much what people don't know, it's what people think they know that just isn't so. So think about our mindset. Think about what we're taught about money. Think about who controls our money, right? First step to building wealth and actually breaking free, by the way, is to gain back that control.